You know, in the world of trading, some of the most powerful signals have the absolute weirdest names. Today, we're going to talk about a chart pattern that sounds like it belongs in your kitchen. But trust me on this one. If you're serious about trading, understanding this pattern isn't just a good idea, it's essential.
So let me just ask you straight up. If you were looking at a stock chart, could you spot a frying pan? And no, it's not a trick question. Being able to answer yes to that, well, that could be a total game changer for your trading results. See, we're not just playing connect the dots here. We are hunting for high probability setups, and this one, it's one of the best out there. And here's exactly why you should care. I mean, really care. Finding this pattern can signal a massive move. We're talking an average pop of 38% after it breaks out in a bull market. Now, that's not just some little blip on a chart. That's a huge opportunity you have to pay attention to.
Okay, so here's the game plan for today. We're going to learn how to spot this frying pan. Then we'll break down what it's made of, its anatomy, we'll look at the hard numbers that make it so powerful, build a trading plan for it, and, this is super important, we'll learn how to know when it's a dud. Then we'll wrap it all up. Ready? Let's dive in.
All right, first things first, let's give this pattern its proper name. We've been calling it the frying pan, and that's great for visualizing it, it really is, but its technical name is the bump and run reversal bottom. Yeah, it's a mouthful, so we'll just call it a BARR for short.
So what is this thing really? Think of it like this. A bear bottom is a major bullish reversal signal. You see it pop up after a stock's been falling for a while. And the shape itself, it's telling you a story. It's saying, hey, the downward push is running out of gas, sellers are getting tired, and we could be looking at a huge turnaround right around the corner.
Look, if you want to truly master this, you've got to know its DNA. You have to know it inside and out. So let's break this thing down into its three key parts. Because just seeing the shape isn't enough. You have to understand how it's built.
Everything kicks off with phase one, the lead-in. This is the handle of our frying pan, right? What you're looking for is a pretty gentle, orderly slide downwards. The price is just kind of drifting down along a trend line, usually at about a 30 to 45 degree angle. This is the setup, kind of the calm before the storm.
And then comes the drama. Phase two, the bump. This is where everyone panics. The selling just goes nuts, and the price falls off a cliff, completely shattering that nice, orderly trend line. That's what we call capitulation. But right at the bottom, something changes. The selling dries up, and the price starts to curve, forming this rounded bottom. That's the pan itself. And you know what's happening there? That's often the smart money stepping in, quietly buying, and flipping the whole dynamic from bear to bull.
And finally, phase three, the uphill run. Once that bottom is formed, the price starts climbing back. It's heading right back towards that old trend line it broke earlier. Now, this is where you need to lean in. The real buy signal, the moment we're all waiting for, is when the price closes above that line. That's it. That's the breakout. That's the confirmation that the reversal is for real.
Okay, so you know the three parts. But listen, the market is full of fakes. So here's a little checklist to make sure you're looking at the real deal. Rule number one, the bump has to be big, at least twice as tall as the lead-in part. This tells you the sellers really, truly gave up. Rule two, follow the volume. You want to see a lot of volume on that big drop and even more on the breakout. That shows there's real power behind the move. And here's a pro tip for you. Use an arithmetic chart, not a semi-log. The pattern just shows up cleaner that way.
All right, identifying the pattern, that's the art of trading. But now, let's get into the science, the numbers. Because frankly, the data is what separates the pros from the amateurs. So let's see what the stats say.
So, the big number you need to know, 38%. In a bull market, that's the average gain after one of these things breaks out. Let's be clear, this isn't some tiny little bounce. We're talking about a move with serious profit potential.
But what about when it doesn't work? Well, that's the other amazing part. The failure rate is incredibly low. We're talking just 2%. And what that means is that only 2 out of 100 of these patterns break out and then just fizzle out. That's an insanely good probability in this game. Okay, let's get into a nuance here. Something called a throwback. It's super common. After the price breaks out, it'll often dip back down to kiss that old trend line goodbye before taking off. Happens more than half the time. Now, these trades still do great. We're talking a 37% average gain. But the ones that just explode higher and never look back, they do a little better, around 40%. It's a small difference, but hey, in this business, every little edge counts, right?
Okay, we know how to spot it, we know the numbers look good, so now for the million-dollar question. How do we actually trade this thing? Let's go through a simple 4-step playbook.
Step 1, and you can't skip this, confirm the breakout. Don't jump the gun. Wait for the price to actually close above that trend line. Step 2, know your target. The highest point in the whole pattern, that's your first goal. Step 3, be smart. As it gets close to that target, if it looks like it's losing steam, think about taking some profits off the table. And step 4, the most important rule of all, protect your money. Set a stop loss below a recent support level. Period.
All right, let me tell you something every seasoned trader knows. You learn more from your losers than your winners. So now we have to talk about what happens when these patterns go bad. Learning to spot a fake can save you a world of hurt.
Take a look at this. It's a classic example of a failure. I mean, everything looked good at first, right? It broke out, gave the buy signal, but then nothing. It came back to the trend line and just kept on going down. Knowing why this failed is just as important as knowing why the good ones work.
So, where were the warning signs? What did we miss? Well, first off, the bump probably wasn't big enough. Remember that 2x rule? It didn't have that real give-up feel to it. That's red flag number 1. And then, look at that throwback. When it came back to the line, there was no bounce. It just died. That's a huge tell. If a breakout doesn't have immediate power behind it, you've got to be suspicious. You know, this quote just says it all. He was so sure. He saw the breakout, he was ready to cash in. But the market just laughed. It's a tough lesson, but a good one. No pattern works 100% of the time. That's why managing your risk is the only thing that truly matters.
Okay, we've been through a lot today, so let's boil it all down. This is the master's lesson. The key things you absolutely have to take away from this.
It really comes down to 4 simple rules. 1, know the 3 phases inside and out, so you don't get faked out. 2, know the numbers. They give you the confidence to pull the trigger. 3, trade your plan, always. Your entry, your exit, your stop. Stick to them like glue. And 4, and this is the big one, respect the failures. Knowing when not to trade is a skill that will save you more money than you can imagine.
So that leaves us with one last question, and it's the most important one. You've got the knowledge now. You know the pattern, you know the stats, you've got the plan. But that's the easy part. The real question is, do you have the discipline to actually follow the rules every single time? Because that, my friends, is what separates the winners from everyone else. Thanks for your time.